Certain market sectors are starting to make waves in the overall market. Some are jumping to the surface while others are falling to the bottom. We're going to dive into that as well as how we are re-dissecting or newly dissecting the market data in a slightly different manner that I think you're really going to appreciate.
Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a bi-weekly show that aims to focus on the trend lines rather than the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Hello and welcome once again to the Trending Report. Today we're going to be diving into data as it ended last Friday, December 9th. And right out of the gate, I want to talk to you about the sectors that make up the stock market, most specifically the S&P 500. It's divided into 11 different sectors. And what a lot of people don't understand is there is just a tremendous amount of undercurrent that is taking place within the stock market. So, when you see the S&P 500 and it says, here's the line, here's what the performance for the day or the week or the month or the year, beneath that, there are all kinds of other subcomponents that are being aggregated together to represent that overall average. So, for example, I live near Lake Michigan, and Lake Michigan in the summer will do what's called turning over. And what it really means is that there's these undercurrents of cold water that are deep down, hundreds of feet down in Lake Michigan. And depending on what's going on with the current and the weather and all kinds of other factors, periodically the lake will literally turn over, where the cold water will come to the top, the warm water will go to the bottom. So one day you'll be swimming and it will be beautiful and comfortable in warm water. And you go in the next day and it doesn't even seem like anything changed at all, except now the water is 20 degrees colder. It literally has turned over during the evening or during the night while you were asleep. The stock market has similar kind of tendencies, if you will. It can turn over, it can move, different subsets can jump to the forefront or fall to the wayside. All these things are moving around all the time. And I think this is a really interesting graphic here. It's going through the first 3 quarters of the year, and it's referring against the SPY, which is an ETF, a very popular ETF for the S&P 500. And so as you'll note here, the SPY at that point in time was down almost 24% for the year. And on this graphic, here is the SPY right here. So this dotted line coming across through here is representative of the SPY. And it comes in, like I said, at just about minus 24% for the year. But then here are all these sectors down here on the bottom. And they're indicating or being broken apart by all of the different subcomponents, the stocks that are within each of those sectors. And you can see what a long string that we have here. In fact, look right here. We've got 2 stocks in 2 different sectors that came in at a plus 100% for the year. And then here we've got a minus 60. We've actually got a handful of minus 60s. Here's some more minus 60 coming across the bottom. But if we dump it all into a bucket, shake it up, and throw it on the table, spilling it out, what we'll find is a negative 23.9%. But as you can see, energy, for example, for the year has, for the most part, been running very strongly. Whereas something more like utilities has been running primarily negative. Obviously, technology has been running significantly negative, with only a couple of outliers up here. But you get a really interesting feel. But then the question becomes, well, how is it that we're seeing such discrepancy? When you see these long lines that are kind of stringing out across the sector from positive to negative, why is that happening? Oh, I just hit all kinds of buttons there. Sorry about that. Why is that happening, or how does that happen is probably a better question. So if we go to this next screen, what we're doing here is this is exactly what we were looking at a moment ago, but we're going to isolate down on consumer staples here. And most specifically, we're going to look at Walmart and we're going to look at Target, just to give you a quick example of how the deviation can take place. So Walmart and Target, basically serve the same clientele for the most part. They're kind of staged together. Obviously, they are both considered a consumer staple. That is the sector that they line up in. And throughout the first handful of months during the year, they were performing relatively the same. But then look what happened in May, about mid-May, prior to going into June. We see this big change taking place on both of the stocks. But then Walmart is kind of handling its own at a higher level than Target has been. And actually, as of November 16, Walmart was actually back into positive territory, whereas Target was sitting at minus 33%. So it just gives you a quick visual as to how these things can get strung out across a group in the sectors and go anywhere from a negative to a positive in the same sector. Now, we also score those sectors each and every time we have this discussion with you. We score capitalization, we score sectors, we score bonds, and we're starting to score international for you as well. In fact, I've tweaked a lot of this because when you dive into this data so deeply, the data has so many rich areas of information in it, but it's hard sometimes to get it in a way that is quickly and easily identifiable. So we continue to tweak that. We continue to find new ways to present this material to you that seems to kind of hit home a little better. And we've done that again this particular time. So here we are looking at all U.S. capitalization, going from small cap to large cap. Right here is the overall stock market. It is scoring in as a bear. You can see the red dot here. It's got a negative macro and a negative micro. And then the tilt is also negative. The tilt is nothing more than basically adding together the macro and micro to see if they're weighing the same direction or if they're outweighing each other in some way or another. So for example, right here on small cap value, we see a positive macro, we see a negative micro, but it's still leaning negative because the micro is in a sense outweighing the macro. But if we look down here, what we're seeing is the large cap, the one top S&P 100, the S&P 500, the NASDAQ 100, which is what the QQQ is. The large caps are really bringing in the bear, so to speak. And up here, we're seeing mid cap and small cap for the most part, as well as value seems to be popping at the very top to start to elevate the market somewhat. But if we shift over here to the right-hand side, this is the total stock market, just same VTI, just as we're seeing over here in the blue bar to the left. Overall, we're seeing a year that is significantly weighing in at a macro level, going negative, leaning towards the bear. And as you can see right here, the micro did come in bear again, even though it had been starting to pop up right through here, but then it took a turn for the worse, which brought the tilt down as well. And obviously you can see the overall trend is a downward trend for the last 12 months, which is what this chart is a one-year chart. Now, if we take the same view, but at the sector level, again, here's an equal weighting of all the sectors right here in the middle, still coming in as a bear, which makes sense because the overall market was coming in as a bear. And then what it's telling us is that these are some of the sectors that are dragging the market down. Information, real estate, which is what REIT stands for, Real Estate Investment Trust, consumer discretionary and telecom services up here at the top, coming in at the bull level, meaning it's positive on both the macro and the micro. We've got health and consumer staples and materials. And then these in the middle, these are what we would call ranging. They're not showing up as a bull, but they're not showing up as a bear. They're kind of bouncing around in the middle. But overall, the sectors are still showing us that downward trend. We're still seeing a bunch of red, not quite as much as we did on the market cap, but similar. Here, you'll notice that it almost looks like something's missing. It's because this number is so small right here, this minus 0.3. It's not showing up as a bar, but it's actually a red bar matching up with the red bar of the micro. So we've got two red bars, which is creating this bear effect that we're talking about a moment ago. Now, if we move on to bonds, you get an interesting view here as well, because again, as we know, historically speaking, as interest rates are going down, the underlying value of the bonds tends to go up. So for decades, as interest rates were declining, we were seeing bonds doing very well. Now, as interest rates are going up, the bonds have had a more difficult time. The only bull that we're seeing in the bond arena right now is long-term corporates. And then everything else is ranging. You'll see a red bar or a red column and a green column. So it's all ranging. Here's the overall market kind of coming in right at the middle. And we're seeing that illustrated here on the chart on the right. This is the last year of the BND ETF, which is Vanguard's total bond market ETF. You can see the downward trend. The macro has been red the entire year down here across the bottom. At the micro level, we see a few points in time where it starts to try to turn itself around, as it is currently doing right now, but it has not been able to outweigh the macro downturn. And then on the tilt, you are seeing, however, it is starting to pull pretty hard to the north, trying to pull hard up to the bull. So we'll see if we will find more bonds following suit with long-term corporate in the near future. And then finally, taking a look at international. International had been trailing the U.S. throughout much of the year. As we're looking through all of this red here, the internationals overall had not been performing well, but now as of late, they have turned the corner quicker than the U.S. has. And look at what we're seeing here with this strong list of bull ranking scores, with the total international stock market coming in here roughly in the middle, which is the chart that we're seeing here as well. And as you can see, the micro pulled out. It looks like in October it started to go to the positive, and then here in December we saw the macro actually go to the positive, which is what brought us this list of bulls. So international seems to be turning the corner. We don't know if that's going to be the first part of a trend that will spill into the U.S. and we'll have the same, or it may turn back around as well, because as we know, Europe and many other parts of the world are fighting inflation and having an even more difficult time than the U.S. is. So lots of data, lots of information. I hope this overview gives you a good handle on all that's going on in the stock market, all that's going on in the equity market, and to a certain degree, what's going on in the economy. Look forward to talking to you again soon.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.